Well, it's all looking a little bit dicey in equity land, but the bulls seem to be back. And we've got Nvidia front and centre, and they're really bringing home the bacon for shareholders at the moment. We've got a bond market which seems to be driving the show once again, and the US dollar very, very sensitive to moves coming through in bond yields. We've just seen a really, really ugly set of PMI numbers, but we preview the Jackson Hole Symposium. This is the trade-off. Well, hi there, my name's Chris Weston. I'm Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds from my good friend Blake Morrow from Forex Analytics. And we're going to be going through all the factors that are going through in this crazy world of markets, the thematics, the themes, the setups, and the news flow that we need to talk about and dissect and look at where the probabilities sit. But before we do, I want to say a big congratulations to the ATP, 50-year anniversary of the rankings coming through. And for people who have seen that, may have actually understood that Pepperstone are the keynote sponsors of the ATP. We're really, really proud of our involvement in the tennis. And so hopefully people have seen that one going forward. So here's to another big 50 years for the ATP. And obviously with Pepperstone very much involved in that one at the moment. Anyone to bring Blake into the programme? I'm going to riddle this programme with tennis puns today, of course, in that situation. Blake, I can imagine you sitting at your country club with Mrs. Morrow, playing a bit of tennis, bit of... badminton, some of the racket sports. Are you a big tennis guy?
You know, Chris, first of all, congratulations to ATP. And I've been known to play my fair share of tennis, but these days at the age of 51, I tend to be more table tennis and pickleball. You know, pickleball is taking over the US.
I've never heard of pickleball. What's pickleball? Tell me about it.
Yeah, pickleball is just like very short, small court tennis with wiffle balls. It's a crazy sport. It's almost, But it's funny, but it's really popular. It's crazy. But I always fancy a good tennis match myself. It wears me out, and it's a great workout. So
yeah, do you not get down to the old to the ranches and get on the cow riding and horse riding and all that sort of stuff?
Negative.
I think they call it rodeos, don't they?
They do. They do call them rodeos here in the US. Correct.
Not your thing, anyway, mate. Let's get on the. Sorry.
You wrangler, you.
Yeah, exactly. Anyway, let's go into topical thunder. Let's go straight into the markets. Let's see what's going down. I want to talk about equity markets because, you know, we were looking pre-OPEX at the market looking like it was rolling over. Yeah, we'd seen a few people looking to buy vol, looking position for slight downsides. And obviously since the start of the new week, we've seen dealers obviously sitting on some short inventory. You know, they're looking to hedge their, they're obviously short gamma last week. They're looking to hedge out their deltas, and they're probably obviously sitting on a sizable short futures position in equity land, and they've probably bought some of that back this week. But then we've seen bond yields looking like they want to roll over a little bit. A few buyers stepping in, and have just a little bit move lower in long end rates, both nominal and real rates, have caused growth to come back in, and have just been pleasured with this absolutely amazing result coming through from Nvidia. I mean, they've absolutely smashed it out of the park once again, reminiscent of what we saw back in May. Obviously not quite the same reaction playing through, but they've managed to lift Microsoft, some of the other AI names, and NASDAQ futures have gone up for a lift there as well. So, yeah, with the equity market moving a little bit higher, certainly growth and tech working once again, the question is, Blake, is it sustainable?
Well, first of all, your title says bad news is good news, and the first thing I want to say is today, when I was with the Forex Analytics community, we were talking about the bad PMIs out of the UK.
They're awful, weren't they? Awful.
They were horrible, and we had seen the German services PMIs come in below 50. I think, and the UK PMIs looked horrible as well. I can't remember which one dipped below 50 for the first time in a while, but anyway. Ahead of that, I'm like, you got to be careful, because if the US PMIs come in worse than expected, which I expected, I'm like, you got to be careful, with stocks. Stocks might get a knee-jerk reaction higher, but growth concerns might eventually weigh on the markets. But we didn't get that today. I was positioned right for it, but my idea of equity markets kind of turning a little sour, that didn't happen. I think the markets were waiting for the Nvidia earnings, which, AI is going to, obviously Nvidia is the next AI company that's going to build killer robots. So that are going to take over the earth. So apparently, Nvidia is the stock you want to own.
Well, it is. I mean,
sarcasm aside, though, I mean, there's a lot of things that kind of work for equities today. But remember, I think it's a lot of positioning too. And we have key event Jackson Hole coming up at the end of the week, actually tomorrow.
So. Well, yeah, we'll talk about that in a second. But yeah, I do think that rates valve's come off. Yeah, yields have come off a little bit lower, and that's just allowed tech to really fire up. I don't necessarily think markets were necessarily short in these names. I just think, that just a little bit of the discount rate coming down has seen capital move from other areas of the market, perhaps value into growth again. The question is has the bond market got legs? I'm skeptical, to be honest, that we're going to see a really big rally playing through. But what was really good about this is if you are looking to hedge yourself against recession risks in Europe, in other places, then I think tech has revealed its hand again as probably the place to be in the equity market, because you've got predictable cash flows, you've got all those big mega cap techs are places to be in the hideout of lower growth, because you're going to get potentially a lower discount rate, which is going to increase those cash flows and the present value. So I think tech's just revealed its hand. If you are looking for slower growth around the world, tech's the place to be. I think obviously gold will do quite well, and we're looking rates trades, but I think tech's just revealed its hand, and I think there's probably going to be outperformance in the short term there.
That's a good idea. And worst case scenario, if there is, if we do see equity markets continue to slide, tech's going to be one you want to be buying on the dips for sure. So anyway, that would be my thought too, Chris. And, it's going to turn us to our next topic. And I want to talk about the U.S. because something that you have said quite consistently over the last couple of months, and it's something that I hope our viewers have taken home and made money with, talking about U.S. exceptionalism. That's been kind of the name of the game over the last couple of months. And like I said, week in and week out, you mentioned U.S. exceptionalism. That's the trade. The dollar has been the reaper of that. I mean, we've seen the dollar rally quite substantially, but the data that we saw today begs the idea that the U.S., at least near-term exceptionalism, is over. And this is like one of those conversations that I had with our traders today about how I feel that this has been such a strong story. And I still feel that at some point in the future, the market's going to look and say, the U.S., even though every shirt is dirty in the hamper, the U.S. might still be the cleanest dirty shirt in the hamper. But right now, I think what we're seeing with a couple things, we saw the PMIs come in, worse than expected. And I think that's going to be
still growing though. They're still growing.
It is. But we also saw the jobs data get revised down 300,000 jobs today as well.
Less than expected.
There's a couple. It was expected, but those are big numbers today, Miles. I know. Hey, stop it! I'm trying to make a point here. But the fact of the matter is I think that U.S. exceptionalism, that story is kind of, I don't want to say stick a fork in it, but I think we're going to be sidelining that for a while, and we're going to start to see expectations come out of the U.S., which is going to hamper the dollar, at least for the very near term. I am a dollar bull, probably going into the end of the year, but right now I'm a little skeptical about U.S. exceptionalism. So what are your thoughts on that? I mean, it's been a big topic of conversation.
Yeah, and it will remain so. I have no doubt about that. It's one of the big drivers of the US dollar on that small theory that works so well. I'm not backing against the exceptionalism story. China, we haven't heard anything that's really tangible there. You're going to get some trading rallies, and we are seeing trading rallies in CNH and the Chinese equity markets, but nothing's solved there at the moment. Europe, well, look at their service numbers and their composite numbers, well, awful. Yeah, the UK, where services now are in contraction for the first time in about 31 months or so. I don't think the US is still on a relative basis still looks pretty good. That said, it is slowing down, and we are going to see payrolls next week, coming out at a slower pace, in my opinion. There are areas of the housing market. I know new home sales were really strong last night, but mortgage rates now in the US are 8%. That is going to impact going forward. So I'm not giving up on exceptionalism. I still think it's the best place to be. I still think we're running around 2.1% GDP for this quarter, which is well above trend. There's not many places in the developed market right now where excuse me, where current growth rates are above trend, and you're getting that in the US. So whether that's priced into the dollar is yet to be seen. But I think if you're looking for the relative growth play at the moment, the US is still the best place in my opinion right now. So I'm not giving up on it, but I'm not one to bet against the great man, Mr. Blake Morrow. But I think, for me, go and have a look at Barkin yesterday, the Richmond Fed president. Yeah, he's saying that the risks are symmetrical, that they could see a re-acceleration in economics. Again, it just makes us. You've got to be open-minded about economics, and us as traders, we've got to be open-minded. We just have to be open-minded about the tape, let alone the economic situation. So anything's possible. It's calling the economics has been a tough one, but I still think, for me, just to answer your question, I think the US it may be slowing down, but it's still relative to the UK, Europe, all those other places. I still think it's probably the best growth area.
Kind of like our women's US national soccer team, right? Right.
Spain would say something about that, and maybe the Poms as well. But there you go. Moving on. I want to have a question from Moen. It was a question about there was a sort of multifaceted, but one of the things we took out was a playbook going through into September into the end of the year. And I think it was based on a point that you made, Blake, a while back about getting past summer liquidity and things really ramping up going into September. So I think Mo was pretty interested in that point, and so I'm going to bring it to you. If we can just tick over the timer just to keep us on point there, Mr. Producer. Now, as we go through, I want you to touch on your experiences, Blake, with liquidity and people coming back to their desks. But if I look into September right now, we've got non-farm payrolls on the 1st of September, 163,000 jobs expected, so that is a slower pace. RBA meeting coming through earlier the year, Bank of Canada, 6th. We've got the CPI number in the US on the 13th of September. Really, really important there. And then the back end of the month, 20th to the 22nd, we've got the Fed meeting, the Bank of England meeting, and also the Bank of Japan meeting. So that's the kind of highlights that I'm looking for. I think certainly that September CPI print is going to be really, really important. And September is, in the last 15 years, the worst month to be long, or the worst month for the S&P. I think we've averaged a decline of 1.1%. And actually, it's been a pretty good place to be long US dollars. So it's rallied 10 after the last 15 years and been a pretty bad place for gold. So I'm not really a massive fan of seasonals myself, but I will say, we've got some big ticket items coming through. September generally is one of the worst months to be long US stocks. Hopefully we see a bit of volatility. But how are you sensing this participation that comes back after the Northern American holiday, the European holidays? Big ballers coming back to their desks. Are you expecting high volatility? How are you adapting your trading strategies to that?
Well, that's a good question, and I'm expecting a lot of volatility the second half of this year. So, being in the FX market, being here on the trade-off is going to be the best place to be, bar none. So just remember that. So when we come off of September, or end of August, we have the Labor Day holiday. Usually after Labor Day, traders start to trickle in. They start to have meetings, and as you pointed out, there's a lot of central banks meeting. Key one being the FOMC. September, was it 20th?
20th for us. But that's where we're going to get the quarterly projections, the SEPs, and all the stuff. So that's why it becomes a bit more important, right?
It does, but I think the pace is going to be set based on what happens on Friday of this week. So at Jackson Hole, which we'll talk about here in a second. But the way I'm looking at it is, especially technically, I think any rally needs to be sold, because on a weekly basis, we are forming a lower high, and that's been very evident over the last month. So any type of rally that we see right out of the gate going into September will probably be sold into. And
you
that's
mean to rally in equity markets?
Rally in equities, rally in risk, and I'm looking to sell into it or buy dollars on that on a dip if we get it, because I think the dollar is going to be the safe haven trade. However, going into the second half of the remainder of the year, it's going to be really dependent on the Fed. And I have to imagine that, and again, we're going to talk about expectations here in a moment with Jackson Hole, but I have to imagine that the Fed is going to keep a steady pace at this point. And so with that being said, I think that, the markets are going to have a rough half of the second as we go into the fall, and then maybe set us up for a nice Santa Claus rally. We call it, the Santa Claus rally at the end of November going into December, just because, you'll have maybe portfolios being marked up. But let's just put it this way. I'm looking for some downside as we head into the end of this year. And I think that forming a lower high on a weekly basis, on a monthly basis, it's not a good look for the markets. I wouldn't be surprised if we trade below 4,000, before we trade to new highs, put it that way.
I think so. I just want to go back a second before Mr. Producer starts waving his hands in the air like he does. But we talked about this idea of bad news being good news. And yeah, look, it's been good for tech. And that's when you start getting that reconcentration risk again. But I think what we'll see is if we do see higher for longer, and we do see economics really starting to that pace of decline really starting to accelerate, either because China hasn't got that fiscal solution, maybe because Europe continues in its way, the UK, and maybe that flows through into a weaker US. I think there will be a tipping point where bad news will be bad news for risk. At the moment, it's good because people are so worried about like the discount factor and higher yields. But I think there will be a tipping point, and I think we may get to that point where bad news means that just people mark down growth and people say that that's going to be bad for earnings and margins and bits and pieces, and then that will just see a broad-based pickup in volatility. And I think we'll get to that point. At the moment, bad news is good news, but I think we'll change that fairly soon, and maybe that comes into October, that kind of time. We'll see.
I know we need to move forward, but I cannot agree more, because a recession in this case is going to mean negative for risk.
Well, it's all been pushed, that recession trade has been pushed back because the data's been so strong in the US. But it wouldn't take much, I think, for people to start looking at that trade again, and that trade is very clean. Gold, for example, which is one of the best places to be there. The positioning's just come right out of the market. Very clean structure there. SOFR rates for next year. We've seen rate cuts really coming out to about 106 basis points. It's all very clean at the moment. The recession trade's been pushed back. If we were to see, a series in the data that says, actually it's back on, then I think equity markets go lower. So that's an interesting one there.
And that brings us to our next topic. Before this happens, let's go over to Jackson Hole. Let's go to Jackson Hole. Let's talk about expectations versus reality. See, it's interesting when you talk about Jackson Hole. There's a lot of people, their expectations is, the Fed chair is going to do nothing. He's not going to say anything meaningful. I tend to disagree, because the market's going to dissect every single word that comes out of his mouth and other Fed governors, the regional ones. They're going to be dissected and parsed, and it's going to translate into price action in a very thin market. Other expectations that I've heard recently are that central banks are getting comfortable with a higher rate of inflation, and that their terminal rate might be here because and they might be able to accept a higher rate of inflation moving forward. And I think that expectation is way off base. I think the Fed and every other central bank totally understands that, inflation at current levels will fall in the same trap that we fell into in the 80s, in the late 70s, early 80s. So, when you talk about expectations versus what's going to happen, that's what's truly going to be driving the markets, is what people are expecting. And here's the only thing that, if you're a stock market bull, this is the only thing that you need. You need the Fed. You need to walk away from this weekend thinking that, hey, maybe the Fed won't raise rates one last time in 2023. That's all that the market needs, to push it a little bit higher as we go into the end of August. But there's a lot of expectations. I think reality might be a little bit different. What are your thoughts going into Jackson Hole this week?
I don't see this being a volatility event. I'm obviously could be wrong, but the question is if I'm holding positions into that meeting, would I look to pare them back because I think there's going to be a big move? I wouldn't be too concerned. I mean, obviously, I want to be in front of the speech. It's going to be 5 minutes past midnight on Saturday morning for us. So, if I'm holding positions over that, then I know it's a risk event that I've got to manage. But anecdotally, right now, I feel like it's not going to be a massive volatility driver. And why do I say that? yeah, look, he's going to talk about this idea that they're getting to a point where they can think about leaving the Fed funds rate unchanged for a period of time. Yeah, look, but they're not going to do victory laps. He's not going to do victory laps at this point, and that means that when they leave rates, this higher for longer mantra is very much that's priced into markets, and he may say that when we leave them, we're going to keep them held for a period of time, but we'll be open to the data changes that come through. The other factor is this idea about I star, R star, this real neutral rate, which is clearly higher than, well, in some people's eyes, higher than where it is at the moment, because we've got a Fed funds rate 5.5%, but yet economics are still running above trend. Is a 2.5% longer run neutral rate still valid? John Williams, the New York Fed president, doesn't believe that's the case. That should be lower. But the market seems to believe it should be around about sort of 3.8% if you look at forward rates. So that's a big exploration point. We know that Jerome Powell is not a fan of R-star, so maybe he's not going to touch on it too much. But if he does, do I think it's going to cause massive volatility? Probably not. I'm not sure. So yeah, I think there's definitely going to be some things that we need to explore in it. Do I think it's going to cause a lasting move in markets? Probably not, but obviously that's a risk that we need to manage. So yeah, you've got to be in front, and this is perfect for your time frame. So again, it just comes into that idea. We've got this big event that's being highly anticipated about, and Jackson Hole has been the frame and the forum for major changes in policy settings. Certainly, Ben Bernanke will speak to that one. And our job as traders is to see these event risks and ask ourselves, where's the skew of risk around this? Is this a potential for a volatility event? And do we want to hold our positions, or do we want to reduce our positions and manage the risk over that? So that's what we're doing, and that's what we're trying to understand around this meeting. So that's a really big one there. Anyway, let's go to the charts that matter. Let's go to that's the setup. I got a few bangers going on today. Bit of diversification coming through in the calls. Excuse me. And we can see the first one I want to bring up, Blake, is the NAS 100, the Nasdaq 100. So I've got this chart here. We tried to break through those June lows. So I've got a bit of a frog in my throat today. And we've taken down. We've found really good support coming through at those lows. Don't know exactly the number, but yeah, we went through the 50-day moving average. We got down to those lows, but we found support. Really, really positive stuff, I guess. And obviously we've seen the fundamental drivers with bond yields starting to fall a bit lower, both on a nominal and a real basis. We saw 10-year real rates breaking out into 2%. And that sort of caused a lot of angst in markets. Dollar rallied on the back of that, but that's sort of come off a little bit. And then we've seen, obviously seen this fantastic result from Nvidia as well. Are we back here, Blake? I mean, yeah, we're back at that sort of horizontal resistance where we sort of saw a bit of a failed breakout. I want to buy the Nasdaq here. Now that we've broken back above that 50-day, I want to buy it. But if I'm going to do it, I'm doing it very, very small size. How are you seeing it?
Well, if you let your mind do any wandering, this could if we stopped around here today, tomorrow, tomorrow afternoon for you, whatever. If we stop around these levels, we might create some sort of head and shoulder pattern. Do I think that that's the case? I don't know. I think equities have a little bit more juice left in them as we head into this week, and I think that the way the dollar moved today it warrants some warnings if you are a bear. So I like the Nasdaq. I hate saying that after such a big run. But I'd like to see how it reacts near these levels too. I think it's a setup because it's a very pivotal level. I think it's pretty clear that if you break below that red line, that's where
your risk. You
have to be on the short side, right? Yep. But right now, as a setup, it's a pivotal level. I think we could go either way. It's kind of
this is where execution can come in really, really handy. So. I'm warming to it. I like it, but you know what? This is where you can use buy stop orders quite well in the market, because you put a buy stop order just above that yellow line, just above the high of that bar, and what you're doing is you're letting the momentum ride into it. You're letting that flow. If it continues going, hopefully that body in motion stays in motion. And so rather than limit orders or buying at market, by buying on stop, a lot of new clients would say, why on earth would you want to take a worse price? Well, you're just hoping for a momentum trade. So we've seen some encouraging signs. It's closed above the 50-day, really good range expansion. Market closed on the high, good breadth in the Nasdaq, driven by such a good result with Nvidia. And what we want to do is just for me, it's leave a buy stop order above that yellow line. A lot of those those breakouts obviously fail, so you want to cut it out very, very, very quickly. But what we're doing in that situation, if it keeps going, you're just letting that momentum going through. So again, that comes down to your execution, and that's where buy stop orders can work quite well in these markets.
Yeah, well, I'm glad you brought that up, because I'm going to take our next setup over to corn. This happened to be one of our viewers' questions. First of all, Eduardo, thanks for writing in, and don't forget, guys and gals, we're taking your questions. So make sure you write that down in the comments down below, so we can take a look at some things that you want to see. But Eduardo wrote in about the dollar Mexican peso analysis last week. He said it was great. I do want to say that I went long the dollar Mex. VIX couldn't break above the 200 DMA, and when it came back down, I sold out of it and took a little bit of a loss. So I tried to play it, but we just didn't get that breakout on the VIX that I really wanted to step on it. So anyway, but he said I would like to see next week the chart of corn. I think it's very interesting technical support, but its fundamentals don't help too much. And I'm not a corn trader and I'm not an ag trader, but I will tell you that weather is going to be a big driver on corn. How many bushels are being delivered, and how much is being produced, and all of those different factors. But I will tell you, technically, we are trying to form a bottom in price with a divergent relative strength, so you can see that clearly. But what I'd be looking for, if you're going to do an upside breakout, you'll notice that the spike highs in August were right around 512 a bushel, so somewhere around there on this Pepperstone CFD. So you break above 515 or so, that's going to be a previous low from, you have to go back to last year. If we break back above that, that'd be bullish, and it'd be a bullish technical breakout where you can utilize those buy stop orders that Chris was just talking about. So Chris, what do you think about corn here?
Yeah, I couldn't tell you the fundamentals. It's one that you put a bit of time into it, but the market tells you what they want. And one of the great things about agricultural products and markets, I love these markets. They trend, they trend with a duration. If you're a trend follower, if you're a CTA, these are the markets you'll end up. Yeah, your job as a trend follower is to have a wide universe of markets, because you've got to pick out those outliers. And quite often you'll see these agricultural commodities coming up, and as you can see there, when you get these big moves, like we saw back in September of last year in Q4, we just had these big moves, and we saw this big move down. So is this the start? If we've got this divergence, this bullish divergence playing through, could this manifest into a trend? Well, we have absolutely no idea. But one of the great things about corn and soybeans and all these kind of orange juice, sugar, all these kind of markets is when they go, they go. And so that's why I love them. Put them on your radar. They do, obviously spreads are not as cheap as euro, dollar or gold or bits and pieces, but you pay for the movement, you pay for the trend, and you're really well compensated for that situation there as well. So yeah, it's been a nice mover. I think you don't need to know the fundamental story. Yeah, prices and trend and technicals is really what you want to be looking there. So I've got no say, but we've got bullish divergence. It could snap up, and this could be one that trends really well. Anyway, Blake, I want to go to a viewer question. I actually got a personal DM to my Twitter from Robert Cassidy, and he was talking about the gold-silver ratio, because last week we were talking about long-short strategies. We were looking at Russell against the Dow. The trade hasn't really done much, to be honest. I'm out of that because it's not working. Hasn't lost me any money. It's just sort of pretty neutral. But I think there was a little bit of interest in this long-short trading strategies, which you can do. Now, one of the ones that we've been seeing quite a bit of interest in is gold-silver ratio. And you can see here, actually, what we've got, actually, I've got it for the wrong way around. It's actually the silver-gold ratio. So silver is the numerator, and gold is the denominator. So what we're actually seeing there is silver outperforming gold in that situation, because you can see the recent green bars. So silver is outperforming. So what we would do in that pairs trade is we'd look to go long silver and we'd go short gold. And effectively, you're just netting off the difference between the two. Yeah, look, if both go up, if silver goes up and gold goes up, well, obviously you want silver to go up at a faster pace. And that's generally what we do. In these long-short strategies, it's really important that not all markets are created equally. And we do know that silver has a bigger percentage move. It's what we call a higher beta market. So a lot of people, when they're doing these strategies, when you start really getting funky with this, is you'd have to beta adjust this. So we know that silver on any given day would go up 3%. or 2.5% when gold goes up 1%. So when we're talking about position sizing and getting it correct, we just need to beta adjust silver to make sure that we're comparing apples and apple on a beta basis. But look, I think this continues to go higher. I think we get a breakout here, Blake, and I think silver continues to outperform, and that trade works quite well in my opinion. So still staying long silver, short gold, I think, in this environment. Any views?
So you think it breaks here? It breaks to the upside, which is interesting because we've had a 9% move higher in silver over the last few days, and gold's only moved like 2%.
Yeah, it's a bit overdone at the moment. I'd probably be using a bit of weakness to get into. But yeah, it's stretched. But I think given what we're seeing at the moment, I think that let's revisit this in a couple of weeks. Because I think this will be nicely higher than that situation. The great thing about pairs trades, long short strategies, is because you are looking at a relative play. It is in itself is a lower beta strategy. So typically we would hold on to those positions a little bit longer than people. You'd never really use these to scalp the market or take intraday positions. These are positions that you can hold for a period of time. But I think in the next couple of weeks this will be nicely higher.
Awesome. Well, I think that's a great setup. And like I said, silver's been absolutely bonkers this week. I haven't been able to wrap my head around it, and I'm glad I'm not trading it currently. But I like that pairs trade, Chris. You always bring the goods.
Interesting one, Blake. Just want to touch this before we go on that. Yeah. Iron ore. We don't trade iron ore. Iron ore futures in China. It's difficult to get those contracts, but iron ore is an interesting one as well. I mean, they're telling you something about stimulus there. That a lot of other people are not seeing. So iron ore's been absolutely ripping, and it's been supporting the Australian dollar. But maybe some of those industrial qualities of silver, maybe getting caught up in that in that sort of copper's moving up a little bit higher. We've seen iron ore really going pretty funky, and maybe that the usage of the industrial use in silver, which is obviously much more prevalent than gold, maybe is supporting silver in that situation as well.
That's a great point. Actually, that's a point that a couple of my colleagues at Forex Analytics were saying the same thing. Like, well, I guess the industrial application of silver, maybe that's the driver. And you might be right. Iron ore complementing silver, or silver complementing
sniffing out the Golden Week holiday in China and expecting those furnaces to ramp up, I guess.
There you go. All right. Well, my next setup is going to be the euro dollar, and I'm gonna talk my book a little bit here. The euro came right to a confluence of support. The great thing is when it came down the 200-day moving average, the dollar index was in breakout territory this morning, following the I say this morning because for me it was like 15 hours ago when the UK Eurozone PMIs missed expectations. Dollar rallied. Dollar missed on those numbers. The dollar turned around. The euro rallied right off of that 200-day moving average, right off of channel support, right off the 618 retracement, which therefore really defines your risk into this next week or into the Jackson Hole Symposium. Now, I know that if we break below 108, it's kind of lights out for the euro, and it's probably, the dollar is going to go into straight up squeeze them all time because the market is still positioned short dollars and long euros. So right now we're playing into that trend, and I'm playing into that trend as well. But it all really, it's all about on these setups. It's all about your risk. If I can sit there and go, Chris, I'm willing to risk 100 pips to make 200 to 300, that's fine by me on a setup. And so that's how I'm viewing the euro. How do you see the euro here?
Well, we've got Christine Lagarde speaking at Jackson Hole as well, and the market's paired back expectations really, quite substantially now for the next ECB meeting. We've got 7 basis points being priced in now, so we've paired it right back, and expectations have really come out of EU rates, which is interesting. We found support when very little is being priced into EU rates. It suggests that if we were to see anything that just teeps it up, then you are going to get maybe some upside playing through. But this is one that I wouldn't be touching at the moment. I'm not touching it, but I'm just waiting for the market to come up. Yeah, we've bounced off that channel support, but does it go higher, or do people sell into it? We don't know yet at the moment, but I want to just see a little bit of buying coming into it, and then maybe I'll jump in. But my preferred trade is actually just set the alerts. If price can close below 108, then I'll be looking to short that because I think that would be much more meaningful.
Awesome.
There you go. Anyway, let's go to play of the day. Let's see what's on mind. I've got a bit of a trade on dollar yen. I don't have a huge conviction on it because we're still not a million miles away from those highs, and I still quite like the US dollar. And as I sort of talked about, the exceptionalism story is real. But I think that there is some scope now building for this to push a little bit lower into 143. We've made that breakout. It looks like it's failing. The market just tried to break through it, didn't like it. Really just lacked that emphasis playing through. We've seen the 10-year coming off. We've seen 10-year real rates, tips effectively coming from around 2%. We've dropped 15 basis points or so, and that's just taken some relief out of the US dollar. It's hard to like the yen. I know we've got Jackson Hole. I know we've got Tokyo CPI prints tomorrow, but I think the fact that we've come back inside that range, that former high, gives me some conviction that we may see a little bit of longs coming out of the market, and perhaps we can go and target that 50-day moving average 143. So I like this short. I want to just leave a pretty tight stop on the trade just above that recent highs, and I want to keep my position size pretty low in this market as well. So if I lose small. So I think this has got scope to come down to 143. Pretty tight stop off 146. Keeping position sizing low in case I'm wrong. And may look to flip the trade if it pushes back above 146. So we'll see what happens there. But I think there's some scope now building for 143.
Ooh, I love false breakouts, man. And one of my colleagues at Forex Analytics said this today, and I found it really interesting. PMIs missed in the UK, they missed in the Eurozone, they missed all through the Eurozone, they missed in the US, but in Japan last night or 24 hours ago, they beat expectations for PMIs. Think about that for a second.
There's your exceptionalism.
Exceptionalism story coming through Japan.
But you've got a central bank as well who just doesn't believe that inflation's going to last, and when you see global growth rolling over a little bit, and then they're validated in their dovish stance. So that's why people like the yen in that environment.
Yeah, we'll see. It's going to be an interesting one. But thanks for bringing that up, Chris. But one I'm going to bring up for my play of the day is the Euro Aussie. I'm already starting to nibble on the long side down here. Now, it says I'm hedging, and you might go, well, Blake, you're long Euro dollar, so you're long Euro Aussie. Yeah, because we're trending higher, and this also is hedging against what I see as a potential train wreck in China. Now, Chris, you brought up a little bit of you're making me a little bit of a worry here. Now I have to go look at iron ore as soon as we're done, because that wasn't something that was really on my radar over the last few days. So now I'm going to have to go look at it. But I like the Euro Aussie on the long side as long as we stay above the 50 DMA. We have a retracement back down to the 166 breakout point there, that red horizontal line. And the 50 DMA, those areas should offer some buyers to step back in. I think we're going to be supported. And like I said, if we have any type of risk off, or China continues to be an issue, and we instead of them shooting a bazooka, they're just shooting little BB guns. If that's going to continue to be the case, the Aussie is going to stay under pressure. If the Aussie stays under pressure, the Euro Aussie, I think, is going to outperform. So I'm hedging a little bit, maybe long euros in both cases, but I'm hedging against a rally in equities or a sell-off in equities.
We haven't talked about the excuse me. We haven't talked about the CNH, the Chinese offshore yuan. Yeah, at the beginning of this week, earlier this week, we were getting quite excited about funding rates. Tom-Next rates went positive for the first time in a while. We saw 1 month forward points going from deeply negative to positive, and people were like, funding costs are going up. It's going to be expensive to hold yuan short, and that had big implications for FX markets, but that was pretty short-lived. So dollar CNH still very much front and center. The PBOC are pushing back on that one. They continue to push back on yuan weakness through the fixings and also through funding channels as well. So I think that's definitely one that still needs to be very central to the Aussie and actually for the dollar flows more broadly. Anyway, thank you very much for everyone who's stuck around and watched us. I hope you got some enjoyment from the show, and hopefully it's beneficial to your trading. We will see you back next week for more of the trade-off. Click the like button if you can, and actually leave a comment on how you're trading the markets, and also any setups that you want us to analyse and go through with our thoughts and your own thoughts for next week. See you then.